So in other words, if you've got a situation where the government is switching from from note and bond finance to bill finance, then what you get is a situation whereby liquidity of the outstanding stock increases. And it's kind of equivalent to a liquidity injection by the Fed. Now, what I'm showing on this chart is something that we've been talking about before, which is called not QE and not yield curve control. Now, what you could broadly say is that the first of those, not QE, is the disguised QE that the Federal Reserve is basically undertaking through subtle means like running down the Treasury General account or running down the reverse repo program or whatever. That's actually injections beyond its stated policy, its current stated policy of QT, quantitative tightening, running bonds off the balance sheet. So they're actually using a backdoor method. And that is shown by the orange area. So you can see that that has been positive, but it's slated to sort of turn down sharply in the forecast period. There may be a little bit of a surge in the next few weeks, but it comes down. And then if you look at the red area, that's what the Treasury is doing through what we, tongue-in-cheek call not yield curve control. Think of this as Treasury QE, another way of doing it. And what is actually happening is that the twist in the structure of duration, available duration in the market, the switch from notes and bonds outstanding to more bills is actually equivalent to a liquidity injection, because the long-term institutions can't get the sort of duration that they want in the system. And therefore, you're really thinking about a general liquidity boost. And that maybe is what the Treasury is currently planning, or that's the outcome. So all eyes have been on the Fed, and the concern is that the Federal Reserve is acting tough guy, but actually behind the scenes, what you're getting is the Treasury is actually loosening the purse strings through this means. And why is it that they do that? Why do they fund through bills? Because it's easy. The appetite for bills is unending, and it's largely because the banks, who are receiving a lot of bank deposits because of the very generous fiscal policy that's going on in America, they're building up their bank deposits on the liability side of their balance sheet, but they need assets to offset that to duration match. And what duration matches a bank deposit is a short-term Treasury bill or short-term Treasury note. And that's exactly what they're buying. So the appetite for bonds has gone up hugely. If you look at the increase, for example, in US money supply over the last 12 months, something like 1.3 trillion of increase has been supported by about a 400 billion increase in purchases of Treasury securities by the banks. So the banks are monetizing the deficit. And this is the worrying aspect. But this monetization is basically causing liquidity to expand. And that's why I think you've got this generous environment in the markets right now. And that's what we need to, figure. For example, let me just evidence that in an earlier chart. That's shown here, where we're looking at the SOFR spread versus Fed funds. And this is really a measure of the tightness in money markets. When that spread is elevated above the tram lines, you start to get tensions in the money markets. And you can see we've had an awful lot over the last 6 months. But look at the latest readings, and that is telling you that something else is going on. And maybe that explains why Bitcoin is testing all-time highs, because there's lots of liquidity sort of going through the system.